The alchemy of low rates has come to a grinding halt. So, what do consumer, corporate, and government rates all have in common? And what will it take to have a balanced portfolio in 2024? We will break it all down for you right here on UBS Trending. Hi, everyone, and welcome back to UBS Trending. I am your host, Dan Cassidy, filling in today for Anthony Pastore. Joining me today here in studio, glad to welcome Jeff Klingelhofer, co-head of investments and portfolio manager at Thornburg Investment Management. Jeff, it's great to be with you here at the table. Thank you for dropping by and for spending some time with our viewers today.
Yeah, it's great to be back. I look forward to the conversation.
Absolutely. So I do have to ask before we get into our conversation, that word alchemy, I understand you use it quite frequently in your written research. In context of rates, what does alchemy mean exactly?
Yeah, look, what I've been talking about with clients has been as we look backward, we've existed in the non-normal period of human history, right? For the last 4,000 years, we've had positive real rates. And as we look back, we've come out of a period of zero rates. And what that has created is what I've been terming the alchemy of finance, the ability to have abundance of capital, a very cheap level of capital, and it's allowed all of us to encumber our own balance sheets from the consumer, the government, and the corporate level, and really pull forward demand. But today we're having to face reality. Rates have risen, and we've got to adapt.
So I like it, tying in a bit of science into finance.
That's right.
So with that lower for longer rates, you feel that's never really going to come back into shape. We've been accustomed to that over the past 10 years, but as we know over the past year or so, it's a much different environment. So what does that mean going forward for consumer, corporate, government balance sheets?
Yeah, I think we're all having to face the new reality of higher rates, which means we're just unfortunately unable to consume in the same way that we have looking backward. So I think one of the most interesting things is to focus, right, if we just very quickly dissect those three balance sheets. Consumers across the board have come out of the GFC in a much better spot. They've releveraged their balance sheets a little bit, and by and large, they still continue to have a very strong employment backdrop. Governments across the board, though, have really bloated their balance sheets, and they're the ones that are showing up late to the party, right? Deficits continue to run high, but we think that's the next shoe to drop in the economy as governments are forced to reconcile currently exceptionally bloated balance sheets. They're having to refinance into much higher rates, where they spent $700 billion in the U.S. last year on debt service. Today, they're going to have to spend well over $1 trillion. Things will have to pull back. And then corporations on the flip side have already faced that reckoning. They are pulling back. CapEx is coming down.
So I have to ask, we're coming off of the November FOMC policy meeting. They did hold firm last week, as was widely anticipated. Looking forward as we get into the first quarter of 2024, what are your expectations for monetary policy from here?
I think it's steady as she goes would be the best way that I can say it. Right? What the markets broadly have been expecting, and I think wrong, and they finally come our direction, is the belief that at the first crack of weakness, central banks are going to step back in and provide a floor to potential volatility. And that made sense. The reaction function was different in a world where they're trying to push inflation up. But today they're trying to pull inflation down, and what that means is they're on hold. They are trying to engineer that soft landing or even mild recession, and at that first sign of weakness, they're fine. They're not going to cut rates proactively, and we think markets continue to have that wrong. So we expect higher volatility as we look into 2024.
So there's been a lot of speculation as to when a downturn might take shape. It's interesting, if we had this conversation a year ago from today, I would pick up on a lot of similarities with respect to the prospects of a recession. It's been long telegraphed. What might the timing be from your vantage point, and the severity for that matter?
Yeah, I think we and the markets, being the broad we, have been wrong in 2023, right? On the back of the fastest and highest rate hiking cycle in most of our careers, really a generation, we expected the economy to crack faster than it has. So recession has been delayed, but it hasn't been canceled in our view, right? Really, when you look at the data, you're just coming into the normal period where the economy would show signs of weakness, those long and variable lags of monetary policy. Not every data point comes in weaker, but broadly, we continue to see reasons why we think the consumer is weakening. Across the board, right? Consumers continue to take on debt. As a result of that, they're having to default on some of that debt at an increasing level. What we've seen is it was the weaker consumers that tended to default. That makes sense as the economy slowed, that 18 to 29-year-old cohort. But what we're seeing today is it's broadening out. That continues to suggest to us a broadening underlying environment where the consumer's weaker, growth will come down. We expect a recession to start in the early part of 2024.
What about the labor market? How does that factor in?
The labor market is held up, but it's already weakened considerably. It's just we have to consider the starting point, right? So the last unemployment print that we saw was we were at 3.9, and that's off the low of 3.4. Sure. 50 basis points is actually very significant. I think as we look forward, going back to those bloated corporate balance sheets, the bar for higher or for continued CapEx is high, and that means that companies are pulling back, they're hiring less, and really what we're watching is consumer sentiment will weaken, right? Consumers consume off of sentiment, not underlying economic data, and sentiment can weaken much faster than underlying material economic conditions materialize.
So as far as investment considerations, Jeff, where are you seeing the most opportunity at the moment?
Sure, I'd say we cross a couple of things. The beauty of all of this is, gosh, if we're wrong in the world of fixed income and we don't get a recession in 2024, we're paid to wait, right? So a lot of the portfolios, our portfolios certainly 6.5%, 7% yields. That's not a terrible outcome if we don't get a recession. I would say the biggest opportunity for investors across the board is to pare back on potential future volatility. So focus within fixed income, shorter on the risk spectrum for credit. You want to balance that with longer treasuries and agency mortgages. And I would say within the world of equities and other credit-like assets, right, you want to focus predominantly abroad. Because today, the starting place for the US equity market, we worried is just, it's a little bit overstretched, right? Valuations are high, and as I talked about, as the sentiment deteriorates, you could see a revaluation relatively quickly. International stocks look much more interesting to us, as does international dividends, again, where you're paid to wait and they're already contemplating that slowdown.
Well, Jeff, thank you very much for dropping by. A lot of portfolio considerations out there, and thank you for sharing with our viewers your macro expectations as well. Great speaking with you today. For more information, please visit ubs.com/views. UBS Trending is on social media. Follow us on Instagram at UBS Trending for content that you won't find anywhere else. You can also check out LinkedIn, Facebook, and X, formerly known as Twitter, for more. And as always, if you have any questions about your portfolio, please speak with a UBS financial advisor. Until next time, I'm Dan Cassidy. Have a great day, and remember to keep your eyes on what's trending.